Good day. Ira Epstein with your SPDR ETF video, and this video is for Monday, and we are now with a wrap-up for February 3rd, 2020, just getting on to 5 o'clock in the afternoon. Well, it was a mixed day in the markets. We can see a number of the spiders all over the place. We had, let me step over here for you. We had the QQQ, which is the NASDAQ, up nicely, the SPY, which is the S&P 500, and the Dow up. In the metal markets, gold did slip back, as did GDX and the juniors, GDJ. Silver market down a little bit. It's interesting that TLT was down, and yet the bonds and notes acted quite firm. So little divergence going on there. But let's take a look first at the technology sector. What the market did is, as you can see, if we come all the way back here, you had a market that on this date, which was January 21st, gap lower. I am not saying charts can't leave gaps. What I'm saying is they generally get filled. So the market began a process of filling the gap, and in the process, it's been chopping around, and this is where you're left. It has filled it, and you are just caught in this range. The market hasn't broken out one way or the other. What are we going to do with coronavirus becomes a big question, because the technology sector is in the way. If they can't get chips, if you can't get parts out of China, you've got to worry what happens. So far, everything's okay in the U.S., not okay in China, and eventually what happens to our suppliers. Those are questions. I was reading about Foxconn today as to if they go much longer, even though they've been able to outsource to other factories they have. If this thing were to go another month or so, say, they would run out of parts for Apple. Now, I'm not making it up. That was the story today in the news. So it gets interesting. There's only so much you can do before you start hurting the supply chains. When we come to the tech spider, lower highs, this low right here, let me point to that one, is under that low. So it really doesn't matter what this 94.99 is. That is not the number that I'd be paying attention to. This was 94.71. So I've had the lower highs, lower lows, but what it does for me is it's a warning sign. The market's in a pause. Suddenly I've got, if you really take a look at it, lower highs and higher lows. To establish the downtrend, you've got to take out 94.99. But what if the market wants to step out into the uptrend? Well, if this market were to take out 97.87 and not take out 94.99, I could just as easily have higher lows and higher highs. Where's that in relation to the 18-day average? It would be over it. So that would turn this market up. Conversely, if the market steps back under the 94.99, I think the pros might sell that market. Wouldn't surprise me, stops over this, whatever today's high is, as long as you first broke down under that number, and maybe the Bollinger Band bottom becomes the support. Let's flip it around. The market first goes over 97.87. That's where my problem comes in. You're going to be fighting pretty quickly with wherever that Bollinger top is, and it's falling right now to the tune of about 20, 30 points a day. So it would still be in the 98.50 zone, so I think you'd attract the buyers. In other words, you can go either way on this chart right now, and when I look at momentum, it's bearish. So the trend down, the bias up because you closed over the 18-day average, momentum down. Fits right in. This market is so confused, and I'm not just talking this particular sector of the market. I am telling you, these markets, they're trying to understand this coronavirus impact as best as they can. On the industrial sector, well, we know that this has been getting hurt. Yet today, what numbers came out great this morning? Factory numbers. So the market, you would think, would have got a bounce, didn't do it. By the end of the day, it was back under the lower Bollinger Band, and it did try to rally. It got up as high as 82.23, but by the end of the day, fell back here. If it continues down, the 100-day average is your support. Now, here's the negative for it being bearish. You only spend 5% of the time outside of these Bollinger Bands. So when you've sold under them, like you are right now, I don't know that you grab a lot of traction. Maybe that's going to change, but I'm just pointing out something there. Plus, you're oversold. I think the pros will cover shorts if you get down to that 100-day average. I don't see them going long there. There's a big difference in covering a short and going long. Energy sector entered a bear market. If you look at WTI, if you look at Brent crude oil, they're down approximately 20%. They have negative sentiment. There's undue worry in the market. It just keeps going. It's all part of what makes a bear market initially, and you're there. So you'll read in the news if you go on tonight to Fox, Bloomberg, CNBC. By the way, I'm going to be on Bloomberg tomorrow morning for those of you that watch it, 9:50 a.m. Central Time. So I'll be on Bloomberg TV at that point. But you can see you're just hugging this market. And if you're a bottom picker, why? Why? You could have picked it there, here. I mean, you just get killed. And if you're trying to sell it, I don't believe in selling under a Bollinger Band. There are points where an event happens and sometimes you walk away from that market. Now the battleground is crystal clear where it's at. It's in the QQQ, right at this 18-day average. It's refusing to follow through to the upper band, refusing to follow through to the lower band. Ever since things got worse on the coronavirus, right back here, we can go to that date, in fact, it's right over here. You had your outside day down, January 24th. It seems like a lifetime ago. But since that time, the market has just been stuck, fighting back and forth and not trending. I can argue a lower low with an outside day down on Friday. You see that? And a higher high. Truly, no opinion on the chart. Momentum sort of funky right here, stuck sideways. I don't see anything that if it goes up makes it suddenly get bullish or down makes it suddenly get bearish as somebody trying to get the swing line, in other words, the higher highs, higher lows, or lower highs, lower lows with momentum and all tying together. Just don't see it yet. Emerging markets. Well, one of the things we had talked about last Thursday was if you continue to break, maybe you get to the 100-day average. So you did that on Friday, and today you got a little bounce. But all that's happened is you get under the Bollinger Band and you're moving to the right-hand side. This is still very much a bear market, an oversold one into a major support of the 100-day average. And if this gives ground in much of a way, you got to start looking at the next 200-day average that can carry the market. When we come to GLD, you have an overbought market, number one. You are in an uptrend, higher lows, higher highs. You've run into a brick wall where you should at the upper Bollinger Band. You only stay above that number 5% of the time. Now here's another piece of news that ultimately is good. Do you see how narrow the Bollinger Bands got here when prices narrowed up and then you had a breakout? You're in the process, and I don't know how long or if it'll hold together, of trying to do that again, developing sideways action. We'll see which way that ends up. In the gold miners, in the juniors, you have lower highs and a lower low, and you closed under the 18-day average. That's bearish, and momentum is trying to turn down. When we come to the full-size miners, you've got higher lows, higher high, but that was negated today. Why? This is why you always look to see where you're at. I can argue you got lower highs and higher lows against the 18-day average of closes. In other words, got a market that's doing that, coming together for a move in some manner there. In TLT, down 36 points today, but you still have the embedded reading. So until this is lost, with the red line closing under 80, it's my belief that on the pullbacks, the traders will be buying this market. They'll bail, in my opinion, if you lose the embedded reading, which means the red line closes under 80, which projects then the possibility of price in the 18-day average in red making a run at each other. On the energies, take a look. This chart's just fallen apart. There's not much I can say. Even if OPEC cuts 1 million barrels a day, it takes 4 to 5 weeks to get that oil from Saudi Arabia to China. In the process of that, you've got other cargoes that have left regularly for China. They're going to have a buildup of oil is the problem. So even if they said no more oil, what's on the seas is already on the way to them. As you look at the euro currency versus the dollar, this is the FXE, you've got lower highs, lower lows. Now you have divergence on this chart. You have momentum that was embedded And when you lose this type of reading with both the red and the blue lines going sideways under 20 for several days or more, when it's lost, you're looking for price in the 18-day average or the closest average. In this case, was also 105.03. They were about together, as you can see, making a run at each other. Sometimes, generally, it takes longer than one day. And now the market's backfilling into some gap that it left right here, and that's about all that I see. The market's got a trend down, oversold condition, and bias down. You put it together, and you're left like this all day long. I'm sitting at my desk going, I want to do some special reports for my commodity people and on certain markets. I don't know where to begin. Normally on a special report, I have an idea. Right now, I'm just sitting here going, not sure. So with that, for those of you that like to learn these indicators, I have a guide called Guide to Technical Indicators. It's made up of 2 volumes. Now you're going to see the titles of it all come here. First of all, it's going to explain charting, but patterns. I think patterns are very important. Trend lines, how do you draw them? And people move them all over. The moving averages, the different types of oscillators. I like a slow stochastic. Some people like relative strength in other markets. Spreads are always important because you're looking to see, is the market going to contango, forward, which way is it going on you? And of course, options primers and money management, can't say enough about it. So if you'd like to get these, it's pretty simple. They're from our good friends, by the way, at Modern Trader and Futures Mag. Go to our website. You'll see this free offering. Go there. You can always call us. And remember, if you like seeing these videos, if you want to see our afternoon SPDR ETF video only for subscribers, we'll give you a free 2-week trial if you haven't seen it. Call my staff. They will get you set up as you're on the phone with them in the morning. You have a good day. I'm Ira Epstein.